Brian Belski, Chief Investment Strategist at BMO Capital Markets, joins us today to give us his market outlook and talk about investment strategy for the U.S. and Canada. Brian, welcome to the show. It's a pleasure speaking with you today.
Thanks so much for having us.
Let's start with your market outlook, and we can start with your baseline assumptions for what you expect to happen in the U.S. next year that will set us up for your predictions for the stock markets.
Well, we recently published our year-ahead forecast for both Canada and the United States. Going back and doing this for 30 years, it's my 23rd forecast on the S&P 500 that I'm publishing as the lead strategist, and ninth one on Canada since we joined BMO Financial Group. With respect to the U.S. stock market, we believe that we're going to see another year of the unprecedented bull market. For those that are not familiar with our call, we believe that U.S. stocks entered a 20-year bull market in 2009. We've remained consistent on that call. And in fact, we believe the lows in terms of the price of the stock market that were made around the globe, but especially in the United States on March 23rd, 2020, instituted and really represented the kickstart, what I like to call the Control-Alt-Delete reset of the bull into the next 10 years, coming out of what was a 30-plus day cyclical bear market. An unprecedented downside brought unprecedented upside. And in fact, on March 23rd, that day, we published a research report saying that indeed was the low for the year, that stocks would rally 50% from those lows, and that actual overreaction, rhetoric-filled, and fear-driven market move was really going to kickstart the next 10 years of the bull market. So we published our piece on November 19th in terms of our forecast for 2021 with respect to the United States stock market and the S&P 500. Our price target is $4,200 on $175 of earnings. So that equates to around 35% upside in earnings growth and around 10 to 15% of price appreciation. Using the unprecedented term once again, 2020 was an unprecedented year in many ways with respect to society, the stock market, and everything that we've had to go through. In 2021, we're going to see unprecedented earnings growth as we come off of these lower bases and as we start to go slowly back into work mode. Now, 2021 is not going to be the end-all be-all in terms of quote-unquote normalization. We think this is going to take 2 or 3 years. But we do believe that we're going to see more of a broadening out of market performance across sectors. Through most of 2017, 18, and 19, we had such strong concentration of performance with respect to communication services and technology. These are areas from a strategist perspective that we have been very bullish on for several years. We maintain our secular bullish call over the next 3 to 5 years in communication services and technology. However, for 2021, we have quote unquote neutralized those positions into a market weight stance, given the fact that both sectors add up to 40% of the market. And we do believe that we can see other more cyclical growth areas begin to expand their fundamentals and broaden out their performance. With respect to sectors, that brings us to an overweight stance for 2021 in consumer discretionary, financials, and industrials. Neutral or market weight areas like consumer staples, communication services, technology, materials, and healthcare, which leaves us underweight in the United States energy, utilities, and REITs. The utilities and REIT side of things, we favor utilities a little over REITs. REITs over utilities, given that they're more economically sensitive. And we do believe that U.S. energy stocks are in a secular decline and need much higher oil prices to work. For Canada, we believe that we're going to see another year of positive returns. And our theme for Canada has been for several years, as America goes, so goes Canada. We want you to focus on those stocks whose business operations are more levered to the United States. And we believe that Canada will attain a price target of $19,500 by year-end 2021. On earnings of $1,100. That leaves us overweight sectors like financials, consumer discretionary, and industrials. If you take a look at those companies that make up those sectors and select areas that make up those sectors, the ones that are more centered toward the United States in terms of their fundamental properties. We believe those are the ones that are going to continue to outperform. And earnings growth from a longer term perspective actually is going to be a little bit higher than the United States. And so therefore we think that Canada, believe it or not, is undiscovered value territory and is kind of a backdoor way to own the United States. Now, in 2019, we were very bullish on Canada. There was a lot of skeptics out there. Canada ended up being a top 5 developed market in 2019. In 2020, we saw Canada keep pace with the United States for the first half of the year and then kind of lose pace the second half of the year out until the last 7 or 8 weeks, where the Canadian dollar has kind of strengthened. We've seen strong moves in financials. And we think that the catch-up trade, at least for the next 3 to 6 months, is especially warranted for Canada over the United States.
Okay. Brian, let's talk about some of the assumptions that you made for going back to the U.S. markets first. So in your report, you've written that one or more vaccines will be publicly available sometime during the first half of the year. At least one more round of fiscal stimulus is underway, around $1 trillion. Policy uncertainty will be declining, and that the yield curve continues to steepen. Now, can you walk us through some of these assumptions here, starting with the vaccine? Now, economists that I've spoken to have said that, yes, a vaccine is expected to be rolled out, but the effectiveness of such a vaccine is limited, especially since not everybody will be getting one right away. Can you comment on that?
Well, I think economists need to analyze the economy and stop analyzing kind of what's going on the health side of things. I think that's what made everybody so nervous and fearful in the first quarter. Remember, some of these very same economists were telling the world that we're going into the next Great Depression and to sell stocks, and that didn't really work out. So I always caution people to stay in their sandbox. I think equity people should talk about equities, fixed income people should talk about fixed income, and economists should talk about the economy. No one really knows exactly what human nature is going to, how humans are going to employ what happens with a vaccine. Be that as it may, what are the facts? The facts are we have 2 vaccines right now. We're probably going to have somewhere along the lines of 4 or 5, given where the pipelines are. We have at least 2 strong therapeutics to treat the virus. And so we're probably going to have 4 or 5 by then. And as we said in our formal comments with respect to rolling out on the market, this is going to take some time in terms of transitioning back to normal. I don't think a vaccine or 4 vaccines are the end all be all to make people more comfortable with going back to work. This is going to be a longer term process. And so that's why I think economic growth rates may be slower, but the stock market will be ahead of that, just as it was in 2021. So I think we're set up for our core assumptions with respect to the vaccine to underpromise and overdeliver. I'd rather be conservative on the vaccine than call the vaccine an end all be all, David.
Do you think earnings this year really caught up with prices in terms of growth?
Absolutely not. Absolutely not. Typically what you see, and traditionally, I think many investors have forgot, stocks lead earnings, which lead the economy. And I think that's the circle of life in investing. And what happened was, given the fact that the majority of companies in the first quarter in the S&P 500 cut their guidance, analysts have not had a lot of guidance. And what's happened, David, in earnings revisions, all analysts have been doing all year long of trying to catch up to where earnings have come. Earnings have come back a little bit faster than everybody thought. And it's still this mode of underpromise and overdeliver. And so that's why I think that earnings in totality are still lower than projections. And our 35% number actually might be too low for next year in terms of the growth rate.
Yeah. Well, this is the other counter argument that I've heard, which is that price earnings this year have the ratio has been overblown, and so that really calls for a reset of prices downwards. Can you comment on that?
I'd love to comment on that. That's short-sighted thinking and more analytically and academically driven thinking. The market and macro economists and strategists have been too focused on quantitative variables and macro variables for 20 years. These are the same people that have been wrong for 10 years and missed the entire bull market between 2009 and February of 2020 because they've been focused on macro variables and focused on academics. If you take a look at a 24 times PE ratio at 0 interest rates, okay, and record high risk premiums, it's telling you to buy stocks. So academic way of looking at the market by only looking at valuation, David, is a trap, because what do we know? We know this, and it's very clear based on the analysis. PEs work over a several year time period in terms of market performance, does not work on the near term. In fact, valuation as a metric and as a factor is one of the worst factors in terms of forward stock performance.
Yeah, I've heard that too. So walk us through some of the indicators that you look out for then.
Well, we look at good old-fashioned bottoms-up stock picking, and I think that's what's going to lead the next bull market. And we said on March 23rd, actually, that the makeup of the bull market would be very different, especially in terms of portfolio construction. So it goes back into actually really knowing what the company does, about their management, about their style, what kind of product or service they're making, what kind of earnings will deliver cash flow, or cash flow will deliver earnings, and what revenue really looks like. And instead of screening for the market and trading in a momentum type fashion, David, which we of course have been doing for 10 years. So this is a bottoms up, good old fashioned stock picking side of things from the fundamental perspective. I think too many people are focused on trying to buy or sell the stock market based on the ISM or employment. Remember, these are all macro variables that are dated, and we have so many people and so many algorithms and so many ETFs that are following macro. Yeah. Of course, it's going to be wrong.
I think a lot of investors who don't know how to pick stocks flock to indices and index funds for the same reason that I just mentioned. They don't know how to pick bottoms up stocks in the old-fashioned way that you discussed. And the concern is that next year, should the biggest stocks not perform as well as they did this year, the entire index isn't going to get dragged up like we saw in 2020. I mean, can you elaborate as to why that belief may or may not be true?
Well, just look at technology, David. If you take a look at technology with a very high market cap and weightings in the indices of Apple and Microsoft, our call on those two names are to maintain those names. And when the market goes up away from your core position as a portfolio manager, you trim a little of your position. And when the market goes down and your position goes down, you buy a little bit more to maintain your core position. But what does that mean for the smaller stocks that we would call more structural growth stocks in technology, whether or not it's PayPal or Shopify or NVIDIA or Visa or MasterCard or Adobe or Salesforce? Those stocks are extremely smaller on a market cap perspective relative to Apple and Microsoft. And that's where you should be building your position. So I think that the performance with respect to not only fundamentally performing, but from a price performance standpoint, can, will, and should be picked up by these other areas as the market continues to broaden out its overall performance.
What are some of the risks to the markets then?
The risks of the markets, everybody turning bullish. Now, there's a lot of things out there in the press. As long as they get pushed back, like you're pushing back, that you're talking to people in terms of all these economists and all these people being negative on valuations and earnings. Mm-hmm. If you look at your Apple machine or whatever you use, your BlackBerry machine for news, 9 out of the 10 stories in the stock market are negative, and we're hitting all-time highs.
Yeah.
And so if you take a look at forecasts by strategists around the world for 2021, they're all over the place. Some are bullish, some are bearish. I kind of like that. If everyone was bullish, I'd be worried. So I think looking at surveys, David, like Investors Intelligence or put to call ratios are not the right way, or certainly watching TV are certainly not the way to be building portfolios in terms of sentiment. You need to talk to your clients. So I will tell you that if I talk to 10 clients a day, 9 of them are bearish. 9 of them are worried about the market. Some of that is because they've missed the market move, but some of it is that they're gun shy and completely missed the big move off the lows in March and have underperformed for the last few years.
Yeah. What about on the geopolitical front, the risks there internationally? One of the assumptions you've written is that risks on trade are likely to decline. Can you elaborate on the assumption there?
Well, what's really interesting is that Mr. Biden's platform with respect to President Trump's is not too different with respect to how he's going to deal with China and the like. But Mr. Biden is not necessarily telegraphing that. But if you actually look at the platform, it's not that different. But clearly, the saber rattling that really engulfed what happened in terms of President Trump's tariffs spooked the markets in terms of international growth. And I think heading into more of a diplomatic Mr. Biden candidacy and presidency, which is the proof is in the pudding. He was in Congress for almost 50 years and knows how to negotiate and knows how to play the political process. I think that will bode well in terms of back and forth trade relations and all the other international kind of malaise that has really defined the saber rattling of the President Trump administration.
Okay, so you think we're going to be out of a recession soon? Then is basically what I gather from your thoughts.
Well, again, I'm not an economist, but according to our economists, we had a 2-month recession. So we're already out of the recession. And so whether or not that, if we start to see an economic recovery, David, I think that's the bigger answer. And given the fact that we're still kind of struggling with respect to how we're going to get unemployment down, we're still kind of struggling with a potential stimulus package between now and year end. We don't know exactly what the stimulus is going to be looking like under the new Biden administration. So there are some near-term risks. But again, I think trying to time the market, David, over the next few months is extremely dangerous. We're longer-term investors. We always look out 12 months, and we think stock prices are higher 12 months from today.
I noticed in one of your assumptions that, I noticed in your list of assumptions, one of them isn't monetary policy stimulus. And you've put down fiscal stimulus. Is monetary stimulus behind us in terms of a driver?
Well, I think some of the levers that both the Bank of Canada and the Federal Reserve, there's other things that they can do, and they will do if Chairman Powell in particular said that they stand, quote unquote, at the ready to do additional things, whether or not that is additional security purchases or not. But it's pretty clear that the Fed is not going to be doing anything in terms of changing its policy for at least 3 years. That's according to our economic department and many others. And so that essentially does mean, David, that they are being accommodative. They're just not going out there and doing the same type of aggressive purchases or repurchases of securities like they were, let's say, between 2007 and 2014. The driver really of what we've seen in terms of money coming into the system has really been the fiscal stimulus side.
Okay. So then going back to what you said earlier, when you turned bullish on the stock market post-March this year, what were some of the main drivers that you were looking at that pushed equities up? Because most people I've talked to cited monetary stimulus as the main reason as to why equities have improved. But it sounds like you saw some fundamentals improve as well. Is that correct to say?
To be clear, we were bullish all year, and to be bearish for 33 days, we don't make daily or monthly calls, David. We believe that the U.S. stock market was in a secular bull market the entire time, just because we had a 20 or a 33 day bear market. I mean, pretty unprecedented, almost impossible to call. So what we saw versus others was we weren't focused on macro variables. We weren't focused on the fear factor. We were focusing on the resiliency of Canadian U.S. companies, period, that they would get through that these were the best equity assets in the world. Again, period. So this whole notion of the only reason why the market's up is because of stimulus. So you have to answer yourself this question. I'm just a common sense kid from Minnesota, right? So if you're given money to spend, you're going to spend on an asset. You're going to buy an asset, right? So what was the most attractive asset in the world? US stocks, and Canadian stocks came along for the ride, period. So what's really interesting about this whole notion is that the market's only going up because of stimulus. Think about this, David. This year, again, 2020, we've had more outflows from equities than inflows. We've had more inflows to fixed income than outflows. Those are the facts. And so I think that there's a notion of the negativity surrounding investing and Wall Street in general has been a dominant theme for 20 years. And this really began post the quote unquote technology wreck in the late 90s, early 2000s. And you've seen people do pretty much everything with their money except buy equities, meaning private equity, hedge funds, real estate, emerging markets, commodities. And equities really have been kind of left on the side of the street. Even after going up for 10 years, equities are still hated. And so I believe that sentiment still is going to be part of the driver, David. We're going to have some ebbs and flows with respect to this, but But just to say that stimulus is making stocks go up, I think is too simple. If we learned anything in 2020, life is not simple. The markets are not simple. So to make easy, simple assumptions, I believe that's wrong.
Finally, safe haven assets. Were you surprised at the surge in gold prices this year, alongside equities?
Well, no, but from a historical standpoint, clearly gold extended. I would think you want to trade gold like you do technology. What I mean by that is maintain your gold positions. Clearly, we're going to have a very big stimulus package, we believe, in the first quarter from President Biden that will further weaken the dollar and lower interest rates. But I do believe from a longer term perspective, gold should be part of your longer term portfolio. But again, on these super spikes in price, you peel back your position. And when the market goes down, build a little bit more gold.
Well, how do you feel about the argument that as equities climb, you should be tapering off your gold holdings and going more into risk? I mean, if I look at some of your baseline assumptions again, vaccine, less uncertainty around policies, less uncertainty around trade wars, those seem like risk-on measures that I should be taking as an investor and moving away from gold, right?
It's a great point, but what we said earlier too, if the Federal Reserve is going to be very accommodative for another 3 years, that means that we're going to have low interest rates for a while. That will put in a bid in for gold, or at least a floor for gold. So again, you maintain your gold position. You're not building your gold position. So on rallies, you sell a little bit, and when gold goes down, you buy a little bit.
Okay. Brian, thank you so much for your time today. That was a great talk. Appreciate it.
Thank you. Thank you very much.
Thank you for watching Kitco News. I'm David Lin.